this is Tony Jenkins, and welcome to this eCPD module, which deals with the question of dividend versus salary. In this module, you will be able to describe the background, to explain the main considerations, identify the issues with national insurance contributions and the transferable married couples allowance, and describe the impact of the other considerations such as the national minimum wage. This module will be relevant to accountants who deal with the taxation of owner-managed businesses, family companies. By way of background, it is common for family businesses to be operated via a limited company. Low rates of corporation tax combined with the favourable income tax and national insurance treatment of dividends as compared to salary meant that for many businesses it was tax efficient to incorporate and to extract profit by means of dividends rather than as salary. The limited company remains the medium of choice on how best to carry on the family business. Directors and shareholders in family companies can choose how and what they take as money out of a company. Value can be taken out of a family company in a variety of ways, and the issue of tax-efficient profit extraction is wide. Other profit extraction strategies include paying interest on current account balances, paying contributions into registered pension scheme, receiving loans from the company, or by letting the company use personally owned property and charging rent. Now let's look at salary versus dividend. A typical setup is for the husband and wife to own the shares equally and for each to be paid dividends up to the higher rate tax threshold. This approach applies equally to civil partners. To retain state pension and benefit entitlement, a small salary is paid that falls between the lower earnings limit and the primary earnings threshold for NIC purposes. National insurance is payable at a notional zero rate where earnings are between those limits, which allows state pension entitlement to be preserved for zero NIC outlay. See later in the module for the impact of the new £3,000 employment allowance and the national minimum wage legislation. Considering the basics, dividends are paid out of after-tax profits. Any money paid out by way of a dividend will have already suffered corporation tax. With effect from the 1st of April 2017, the rate of tax for all companies is 19%. Money paid out by means of salary or bonus attracts a corporation tax deduction. Payments made in this way attract a Class 1 NIC liability where the secondary threshold, employer contributions, and or the primary threshold, employee contributions, is breached. Currently, these are at the same level. PAYE must be applied as the salary or bonus is liable to income tax. Now let's consider the factors related to the most tax-efficient option. The most tax-efficient solution will depend on the relative rates of corporation tax, income tax, and national insurance contributions. Dividends must be paid in relation to the shareholdings and thus lack the flexibility inherent in salary and bonus payments to pay different amounts to different individuals. This can be overcome by having a different class of share for each shareholder, allowing different dividends to be declared for each class of shares. It should be recognised that HMRC regards so-called alphabet shares as potentially manipulating the rates of tax suffered by the taxpayers. Where profits are extracted by way of dividends, it is important to ensure that these are properly declared in accordance with Companies Act's requirements. Failure to do so paves the way for HMRC to contest that the payments are not dividends at all, but remuneration, and to apply tax and national insurance contributions accordingly. In deciding whether it is better to pay a salary or a bonus, there is no substitute for crunching the numbers. This needs to be considered both from the perspective of the recipient taxpayer and the company. Remember that the goal is to maximize the amount of profits that the directors, shareholders, and family company can retain. This screen examines the rate of tax and amount retained when a bonus is received by a higher rate taxpayer. Pause if you need extra time to consider the figures. This screen examines the rate of tax and amount retained when a bonus is received by an additional rate taxpayer. Pause if you need extra time to consider the figures. This screen examines the rate of tax and the amount retained when a dividend is received by a higher rate taxpayer. Pause if you need extra time to consider the figures. This screen examines the rate of tax and amount retained when a dividend is received by an additional rate taxpayer. Pause if you need extra time to consider the figures. Let's consider the impact of the £3,000 employer NIC allowance, which is considered on this screen and the next. Previously, when extracting profit from an owner-managed company, salary would have been withdrawn at a level guaranteeing that no employee or employer national insurance was payable. For 2018-19, the limit is £8,424, and for 2017-18, the limit is £8,164. Gross dividends would have been extracted to ensure that taxable income was just below the higher rate threshold. For 2018-19, this is £46,350, and for 2017-18, £45,000. And so no higher rate tax was payable. The limits apply in the UK other than in Scotland. Adopting this low salary, high dividend strategy may mean that the small owner-managed business wastes the £3,000 employer national insurance allowance that now exists. By increasing the salary withdrawal to equal the personal allowance, a small amount of employee national insurance becomes payable, but any employer national insurance is covered by the £3,000 employer national insurance allowance. Although the limits for the personal allowance and the higher rate threshold are known for 2018-19, this example uses the data for 2017-18. If we take a salary equal to the personal allowance of £11,500 instead of the usual £8,164, taxable income will consist of the £11,500 salary plus gross dividends of £33,500, totaling £45,000. No higher rate income tax is due. Employees' NIC on the £11,500 salary will total £400, but no employer's NI needs to be paid due to the £3,000 employment allowance. This route incurs an additional £400 cost, but saves corporation tax of £634, which is arrived at by looking at 11,500 minus 8,164 times 19%. The overall tax and net savings is £234. The employment allowance is not available from 6th of April 2016 to companies whose only paid employee is the sole director. Moving on to the transferable married couples allowance and its impact. From the 6th of April 2015, where one spouse or civil partner is not using their personal allowance, they can transfer up to 10% of the allowance, provided that neither party is a higher rate taxpayer. In 2017-18, this is worth £230. A small amount, but still a saving that is worth having. If a basic rate spouse is employed outside the owner-managed company, then paying the lower salary of £8,164 means that some of the unused personal allowance can be transferred to their spouse. This negates the benefit of increasing the salary to £11,500 when you have a basic rate spouse who could utilise the transferred allowance. In deciding whether to take a salary of £8,164 or £11,500, clearly it is important to consider the employment and tax position of both parties. National minimum wage considerations are important, which are covered on this screen and the next. The National Minimum Wage, or NMW legislation, seeks to ensure that all workers receive a minimum wage level. See the notes for the rates for 2017-18 and post the 1st of April 2018. Adhering to NMW legislation is not a problem in relation to a shareholder director, as the legislation only applies to workers with a contract of employment. Therefore, the NMW legislation does not apply to directors unless they also have an employment contract, and it is therefore possible to pay them a small salary, or indeed no salary, and extract profits by way of a dividend without falling foul of NMW legislation. However, where other family members who are not directors work for the company, the NMW legislation applies, and such workers must be paid at or above the national minimum wage. This may impact on a policy whereby the majority of profits are extracted by way of dividends. Finally, where other members of the family have unused personal allowances, consideration may be given to employing them so as to mop up their personal allowance. This can extend to employing children so as to use their personal allowances. However, care must be taken here to ensure that the children are actually being paid to do a job. HMRC do not look favourably on arrangements that are essentially the payment of pocket money by the company. The amounts paid to the children should be reasonable in relation to the work done, and should also take account of the relevant legislation on employing children. In summary, the key things to remember from this module are the background behind the key methods of extracting profit from a company, the factors involved in the decision between dividends and salary, the impact of national insurance contributions and the transferable married couples allowance, and the considerations relating to the national minimum wage and employing family members. I trust that you have found this module, which deals with the question of dividend versus salary, informative. You can print out your certificate or personal certificate by clicking on the link. Goodbye, and thank you for using CCH eCPD.